everyone. Welcome to another edition of Tokenized. I'm in a hotel in Florida right now, so if you don't recognize the background, that's where I'm at. But I have a very special guest today joining me, Kyle Sonlin. He's got his own show. You probably recognized him if you're in this space from all the things they're doing with security tokens, and we're going to jump into that. But before we do, Kyle, would you briefly introduce yourself? I know you've got a storied career here in the space, but just briefly.
Oh, well, I appreciate that. Thanks for having me on, Mark. My name is Kyle Sonlin. I'm the CEO of STM.co, Security Token Market. We're the Bloomberg of tokenized assets. These are real world equities, real estate, debt products, $25 billion worth of assets at this point, growing 10x year over year. We're tracking it, going from brokers, going from exchanges, everything around the world. I've been in blockchain for almost 10 years, specifically started on the artificial intelligence side, working with consensus mechanisms, which is a lot of just the underpinning technology of blockchains, and eventually realized, thanks to my co-founder Herwig's expertise in the security space, that Wall Street was the biggest killer use case for blockchain technology. And so since that point of maybe early 2018, we've been working in the industry, building solutions to drive that adoption. That's a little bit about me. I'm also here in Miami, so shout out to Florida.
Yeah. Hey, there we go. We should have done this live. What are we thinking? What are we doing?
Yeah, right?
Yeah. All right. So my first thing I want to talk about is get into why did you choose to get into the security token industry? You've been in it for a long time, haven't you?
Yeah, I think that my frustration with blockchain when I first got into the industry was that there was a lot of opportunity with the technology, but there was so much that were a lot of investments that weren't treated like investments. We weren't appreciating the values that have been built by the US capital markets. And so I think the technology is really cool, but that doesn't mean that we have to burn down 250 years worth of successful capital markets that the US has built in order to take advantage of this technology. And so as I was traveling the world on panels and lectures at universities or in conference centers, so many of these blockchain conferences involved companies trying to create new digital assets, whether it was at the time ICOs, whether we see NFTs, DAOs, a lot of these crazy blockchain digital asset instruments that just weren't sensible investments. Maybe there was speculation and maybe you could be really successful, but I always had a problem with the fact that there was no underlying asset. There was no real ownership of anything. And my background, I learned from the school of Warren Buffett and Ben Graham with the intelligent investor, looking at book values, understanding, okay, what's this thing really worth? And when you look at what any of these things are really worth, it's really zero. So with security tokens, it was this natural progression for me of, okay, well, the technology's cool and we have all kinds of benefits and efficiencies, and we'll dive into some of that later today here on the show, but we should apply that to the tried and true things that actually have value, because from my perspective, that was where most of the benefits were actually going to be realized, is in stocks, in real estate, in these actual multi-$100 trillion asset classes, as opposed to trying to create something totally new that no one's familiar with.
And totally new that no one's familiar with. Also, that is rife for fraud. And as we've seen, that's what's happened. And now we have an SEC coming in with a heavy hand and basically declaring everything a security, with the exception maybe of Bitcoin. I mean, Gensler wasn't answering any questions. So do you see this to be an inflection point for security tokens? You're going to have regulation coming in. I've done several videos on how I believe that this regulation is going to kind of tank the crypto market in the US, and it's all going to become securities. That's my kind of opinion, and that's what I'm telling everybody right now. It's the writing's on the wall. What's your view on, basically this is an inflection point, coming regulation, what have you?
Yeah, I definitely think that it's going to be harder and harder to raise funds through a lot of these crypto vehicles, which is probably for the best. There's a reason why when you have an early stage business, of course, you have the opportunity for appreciation, but those investors have protections. And so I think that it's very valid for the largest capital markets infrastructure in the world, which is the US here in our economy, to look at it and say, we want to preserve the liquidity and maintain a lot of the protections for investors. Make sure that we have these subscription documents that are properly done. Make sure that the investors participating are who they say they are, so that in the event that we have litigious circumstances when somebody needs to sue, we have somebody accountable for it. So I think that is totally fair and just. And when you look at a lot of these token sales, they were used to essentially as pseudo equity. I think that the fun thought experiment that was brought up by Mike Lingle and a part of our team, and it was just this idea that if Ethereum sold stock in their company as opposed to the crypto, how many people would sell their crypto and buy the Ethereum stock? And I actually think it's probably a lot of people, myself included. I'd love to have ownership and exposure to the Ethereum Foundation, the same way that JP Morgan wrote a $50 million credit note to Consensus and to a lot of the different underlying private companies that were built and spun up from the Ethereum ecosystem. You know, you look at the VCs that participate in these foundations, they're not always just buying tokens. They're oftentimes buying equity as well in a lot of these underlying companies. Those institutional investors see something there that the retail audience isn't getting exposed to. And I think that disconnect is unfair. So I think that that's a real thing. But we are starting to see a blend, and it is interesting because it's tough for Gensler and the SEC to actually push through with a lot of the things that they want, because there's a lot of resources fighting back the other side. And a lot of these assets may or may not actually look or act like traditional securities, which does make it very, very difficult to try to fit them into any one box. So I think that this is a huge potential inflection point. But what we're really seeing, what I'm excited about from an inflection point perspective, is that the development of the industry is happening by the banks. You're seeing tens of billions of dollars of debt created by Goldman Sachs, JP Morgan, UBS, all different institutions. Siemens just did a $60 million debt offering on Polygon. You've got trillions of dollars of debt that are, the banks know what's going on here. Their only job is to make money and to reduce their cost of capital. They see the writing on the wall, and we're now finally seeing that adoption actually happening.
Yeah, I would encourage people to look up Bank of America. This is just in my newsletter. They finally signed on. I mean, old stodgy Bank of America. Citi did a great report. It's like a 162-page report on tokenization of real-world assets. So the banks are starting to get it unbelievably. But it doesn't seem like we've got mass adoption or even crossed the chasm yet with security tokens. And I first started trying to do a security token in 2017. We just gave up and went utility. So what do you think what needs to happen in order for us to see this kind of mass adoption of security tokens and tokenized assets on the blockchain?
To be honest, I think there's a lot of different ways you can go with that question. I think there's one really simple answer, and then we can certainly dive into the more nuanced ones that take probably 15 minutes to really break down. The easiest, most simple one is that no security token has actually returned anything to investors. I think that bringing a killer use case into the industry is really what drives adoption. When you look at why does anybody care about crypto, it's usually because Bitcoin hit an all-time high. And so now everybody wants to join in on the fun because they've seen all the success happening. So there are projects coming to market. There's over 200 tokenized securities. The unfortunate reality is we haven't seen any of them net a 10x return for their investor base yet. If we can drive that real successful traction, that's the selling point that I think a lot of certainly retail, general audiences, mainstream media, the only things that they care about are those pie in the sky returns that we're seeing in crypto, we're seeing in NFTs. Nobody cares? Most people have never used the word fungible before in their lives, before the NFT craze, right? But because of the fact that a lot of people were really successfully returning capital, now everybody turns their attention to it. So figuring out how we can generate those types of opportunities. And then it's just a numbers game at that point.
Yeah, I mean, there are reasonable returns in the security token market. I mean, INX just had their first dividend from one of the companies that they have on their exchange given out. So we're starting to see it. So have there been no sales of, like, you know, the Aspen project that was done on through a security token? Have there been no sales to have people realize those returns? Is that the issue? Because there's plenty of security tokens out there. Are you saying none of them have had a return at all?
I think they have returned. The problem is that we've seen, I think Aspen's a great example. They've done a wonderful job. They have great disclosures. They have a very successful business, which is operating a enterprise in the St. Regis Aspen Hotel. And they publish their returns, they publish their income statements, they publish their occupancy rates. But whether it's tokenized or not, unfortunately, we're also seeing a lot of fractional ownership real estate platforms that are going under in this current market because it's just not super liquid. So I think that there's a chasm from a retail perspective for the average investor doesn't buy a lot of these types of assets at this time. Does that mean that they won't forever? Absolutely not. But we need to figure out how to create things that people want to invest in. Where do you see a lot of people talking about in the stock market? They talk about tech. Why? Because Tesla, you could buy it at this price and it's going to double or triple or 4 times because of the craziness of Elon. Or you look at people buying Amazon stock and seeing the returns, or Apple. A lot of the tech stocks are what really drive so much excitement in the markets because of the outstanding return potentials. And not that we should be hunting for that necessarily, and not that that's maybe the most sustainable strategy, but it's what turns eyes. It's what gets people excited. If you're talking about short term of other opportunities to diversify your portfolio, I think that real estate is an exciting example. I think that credit and opportunities in the debt markets are an exciting example. But is that getting headlines? Is that really going to cause people to throw money hand over fist to get a 7 to 10% yield on their investment? You know, it's a more nuanced question, I think.
Yeah, I think you're right. I mean, I haven't thought of it that way, where's the big potential for big returns? Well, I would say, what if you tokenized a cap table of an exciting company? What if SpaceX decided, hey, instead of going public, we're going to issue security tokens for our company?
Which, by the way, it actually is through AmbiSafe's order book that we track on our platform. We work with AmbiSafe quite a bit. We have a partnership with them. They essentially have an SPV or a fund that has tokenized some secondary market shares of SpaceX, to use your example. But I think you're spot on. That's exactly the type of businesses that we just need to keep onboarding, is to get people excited. Imagine if you could invest in pre-IPO shares in a lot of these different businesses and create that platform that's just as smooth, just as accessible as a lot of the other pieces in the market today. Now you're starting to generate some interesting excitement.
Yeah, I mean, you already have these pre-IPO type sites that are doing that, whether it's a Reg CF offering or a Reg D that's been put out as a PPM and people are investing. So it's already out there, but the security token industry, for whatever reason, hasn't simplified it to that degree and hasn't made it easy to get onboarded. I mean, just joining DigiShares and INX, and I love those two organizations, they scrutinize the living daylights out of you. Whereas when you sign up for an account on E-Trade, it's not as hard. Yet, you know, they're asking, it should be the same process. It should be just as easy. But for some reason, security token industry has made it extremely difficult to prove you're an accredited investor. I mean, the amount of paperwork I had to give them was off the charts, and it took way longer than it would signing up for, you know, something in the traditional finance industry. What are your thoughts on that? How do we make it easier?
Yeah, it's a tough question, and this dives into some of the other hurdles for adoption. I certainly think that it's not easy for brokers that are digitally native or leveraging blockchain technology to get the same level of access that more traditional players have. And I think that I've heard from many different players that they definitely face enhanced scrutiny from the individuals that are in charge of and have authority over what they're doing. They need to cover their bases just as strongly. They're naturally participating in a market that, to your point, is rife with scams and with fraud. And so naturally, they almost are immediately on the back foot. They're put on the defensive because of the fact that they're associated with a lot of these pieces, when of course they're familiar with the fact that that's not the industry that they're participating in. I think that the other issue we've heard is that language. I don't necessarily think that the current regime even really wants this adoption to fully happen at the scale that we see the opportunity for. And we just need to figure out how we can help them understand that, to your point, if these things are considered securities, we need to figure out what that onboarding tool is to not only help those issuers who may have made mistakes resize or reissue their shares, but future players, future, industry leaders, we need to give them the path. We need to make the path clear for them of how they can follow this in a way that is going to be compliant moving forward and is trustworthy. And so I think that's consistently been a constant push-pull, is that I don't know if either side fully has a clear idea on the other's position on how we can streamline that process. So certainly from a user experience perspective, I think there's a long way to go for the industry in terms of making the onboarding process easier. But given the current market climate and the current market sentiment around digital assets, it's definitely proven to be pretty cumbersome from a regulatory perspective as well.
Yeah, it's interesting because, like you said earlier, the banks are doing it. BlackRock, Larry's come out and said, "Hey, this is the future, the tokenization of assets." Yet we still have this chasm. I see it as a big, crossing the chasm problem. Is how do we get even the early investors on board? Some of them are, and then the whole mass adoption. And just thinking through what you said, it might take like a very prestigious project. I bring up a SpaceX or something big that hasn't been on the blockchain yet, or I'm sorry, hasn't been gone public yet, or like Twitter. Yeah. Twitter went private. What if Twitter issued security tokens from their current company? You could do that as well. Something like that, I think, would drive a lot of adoption, and we haven't come up with that project yet that I've seen. Maybe you know of one coming up the pipe. But that would really work well.
I also think that properly quantifying the benefits of the technology is a constant battle, but one that we're working on quite a bit, being a firm that has so much in-depth research, a lot of proprietary data and algorithms that we've built around what's going on in this market. We've got millions of financial transactions across dozens of brokers internationally on these traded assets that really is not seen from anywhere, and no one else has a lot of the computational systems that we've built. We're trying to figure out how do we quantify, and we have research from Peter Gaffney and our advisory team on what are the exact benefits, not only from a descriptive perspective. We could talk all day about how settlement and clearing are more efficient and these types of ideas, but what does that actually mean for the dollars and cents? And so where I'm seeing there's a little bit of a barrier to entry from institutions to participate is that it's not quite clear how exactly they can reduce their cost of capital by leveraging the technology. And when you're talking about an institution, there's certainly the retail angle, like you're talking about getting mainstream adoption from the average person. But even crossing the chasm, to your point about early investors, about qualified investors, about institutions that want to tokenize their basket of assets, their portfolios, it really comes down to one thing, and it's the cost of capital. How expensive is it to facilitate this origination and opportunity? Is it, if you can prove that the valuations of real estate can be incredibly efficient and you cut your closing times in half, that is a real material value that could reduce fees. If you've got distributions that need to happen on chain, whether it's a debt offering or real estate where they're paying out yield to their investors, if we can show that paying out yield on chain, just like with Spice VC, which they came out and mentioned their distributions on chain were drastically improved by actually leveraging on-chain payments as opposed to doing it manually, issuing all of these things manually, having a firm that has to track down every LP and send these things out. If BlackRock can revalue all of their assets in a much more efficient process in an automated way, and that can reduce their costs by a factor of 3 to 5% on $1 billion or $1 trillion worth of assets. We're talking about real money efficiencies here. I think that that's really where the security token industry also needs to position itself, because on top of bringing high quality assets to market, that's important. You got to convince issuers why they would even do that. And the only real way to do that, especially if trading doesn't fully exist, or if that idea of having all these individuals that want to participate isn't there yet, at least the benefits of managing this asset can be automated. And we know automation transformed every industry over the last 15 to 20 years. The financial markets are still very analog. You look at the credit markets, the debt markets, which for anybody that doesn't know, debt is about 3 times bigger than equity. So the stock market times that by 3, and that's the debt markets. They're still done over the phone and from one banker to another. Like, we're in 2023. How is that still possible? That it's all, there's no technology there. So if you're somebody looking to issue debt and I can get a better rate on my debt by issuing a tokenized offering, like, by the way, what we saw with Fat Brands, which did a $40 million debt offering that was actually rated higher by Morningstar because they were using blockchain, because of the enhanced transparency. That means you can get a better rate, a cheaper cost for your debt. And so more individuals are going to want to use that. More institutions are going to want to focus on that. So I think that there's 2 different pieces. There's the bringing high quality assets on chain, which we need to continue to do, because I don't think there's enough household names in the industry. I don't think there's enough opportunities, because there can always be more. And then also, it's helping quantify, what are we actually doing here? If this isn't just buzzwords, if this is real technology, then we need to have real results. And so building through those case studies is something that just takes quite a long time. It took a few years, as you mentioned, for you, and we did a tokenization ourselves, and we know other clients that have done it. It might take 5 years to go from ideation at the beginning all the way to execution and wrapping the process up. And then we need to then figure out, looking backwards retroactively, what benefits were realized.
I mean, I couldn't say it better myself. I think as someone that's focused on the space like you are, and by the way, at the top of my newsletter, I put your top 5 tokens that you have on your site every single week.
Thanks.
So just to let you know that. But if we were to make it easier for people to onboard themselves to these platforms and give them reasons to think like, hey, there's a big opportunity for you to go 3x, 5x, 10x. Oh, and by the way, there could be dividends. By the way, via smart contracts, there could be special discounts and awards and other things that you see in crypto. All can be done on a security token, but that follows the law and the regulators. I think if we can get people to that point, I don't know when that point's going to be, but I see it. I know it's the future. I'm not the only one who's said it. You got some big names from BlackRock and now Bank of America, and you cited some other banks. It's going to happen. But I think that in order for the mainstream to get there, it's got to be easier, and we've got to see those high-profile projects that are up there, and probably some regulatory changes. I remember when the Crowdfunding Act, which was part of another act, came through. The
Jobs Act.
And it made it easier for companies to raise money through crowdfunding. We might need something like that for security tokens, because it was clear to me in Gensler's testimony that he wasn't answering any questions on this. He doesn't know what a security is from a utility. And if he does, he's keeping it to himself, because he was asked about XRP. He was asked about Ethereum. Couldn't answer, didn't want to answer. So unless there's a regulatory clarity, I think we might have an obstacle there. So any final words before we wrap things up, Kyle? This has been a great episode. We went over the time that I had allocated, but I certainly want to have you on in the future to talk about other things that are on my mind.
Well, really appreciate you having me on, Mark. I think that from my perspective, if you're somebody who's participated in the crypto ecosystem, I think the term security is naturally scary because it's got this negative connotation from a lot of these individuals, but it's really just the framework we've always been using. And there's a reason why the US market is the leader in this position, the most liquid market in the world. And it's because we've added investor protections. And it's because we've built these things so that we can provide a really healthy economy for individuals. So I think that just the idea of changing this concept of demanding the actual ownership of real assets and then figuring out how we can layer in the technology to make it more accessible for individuals is the focus. If you want to see or learn more, stm.co, that's our platform. We've changed the domain. We're working through launching a whole new platform and site. Hopefully in the next couple of weeks, you can check it out now early. And we got a lot of materials, a lot of research, a lot of reporting on what's going on in the industry. Don't shy away from demanding better quality investments because you deserve it.
Right. Thank you very much, Kyle. Hi, I'm Mark Fidone with Smart Blocks. I'm giving you my tip of the week. This is the crypto tip of the week. It's called Tetragard. You can see it right here. This is the world's first decentralized crypto ETF, which has Bitcoin, PaxG, Ethereum, and this fee token called Quadrant. You want to learn more about it? Go to tetragard.io. This is a big buy for you right now.